What's going on, guys? Welcome back to another video. Today we're going to be talking about the bid-ask spread as well as bid size and ask size and how you can actually use that as an options trader to your advantage. Now, a big mistake I used to make when I was just starting out teaching myself how to trade is trading options that had a wide spread. Scenario would unfold a little bit like this. I would see a high-flying stock, making a great move and thought it had a setup there. I would usually enter the contracts just by slapping the ask, taking the ask price on a no-name high-flying stock. And what would happen is, even if I was correct on the direction, I would usually be holding a position that had marginal gains or even a loser just based on the spread alone. Now, this happens when you have options that have extremely wide spreads. We take a look at Apple here on the screen. You can see the spreads are pretty tight. We're looking at a 5-cent spread between the bid and the ask price. That's a nice tight spread. Something like Beyond Meat recently IPO'd. You can see these spreads have tightened up towards the close, but this morning I was looking at them and there were very, very wide spreads. It was like about 20% difference in the spread. And so what that means is if you are going to enter a position and let's say, the spread is 20% and you buy it at the ask and you have to go ahead and sell at the bid, this is worst case scenario, of course. But hypothetically speaking, if you bought at the ask with a very wide spread and you were forced to sell at the bid to get out of the position, you would immediately be facing a 20% loss, seconds after you entered it, even if the stock does absolutely nothing. And so you have to be very cautious and cognizant of the spreads on these options. Now, these days when I see stocks that are high flying and I haven't really heard of them or I'm not really familiar with the underlying, the particular stock in question, I'll first glance at the options chain before I even look at the stock chart, just because I'm not even interested in the stock unless I can trade the options, unless there's a nice tight spread on the options. Without that, I'm personally not interested as an options trader. Just remember that the spread is going to keep you safe. We can look at a few more examples here. Chipotle. Can see that the spreads are fairly wide here. There's greater than a 10% spread. We have a $1 difference between the bid and the ask on the at-the-money contracts. That's going to be a little too wide for my personal liking. I would not trade this. Now, these wide spreads can be ideal if you are a premium collector, if you're an option seller, sell to open. Personally, I'm generally long calls and puts with my particular strategies, and so messing around with these type of options and these spreads is just not for me. When we look at SPY, one of the most liquid options out there, you can see how tight these spreads are. Those expired today, but looking at even Wednesday contracts, very, very tight spread. Now, the spread gets tighter as we get a larger audience. So basically, the larger the audience you have, the more participants in the market, the tighter the spread becomes. And so just think, audience liquidity. When the spread is wide, there's not much volume. I have been in scenarios, again, as I mentioned, when I was first starting out and learning, teaching myself how to trade options, I would get caught in those scenarios with wide spreads. I've been in scenarios as well, similarly, where I didn't even look at the volume on the options contracts and I bought, and then there was no one for me to sell it to. So this all ties in together. Volume, the spread, liquidity, audience, kind of all ties in together. And with these ideal scenarios, you are going to have a nice tight spread. Remember, this is ideal for options traders, for traders in general, but you always want to be looking at how wide is your spread on options contracts. Moving forward with bid size and ask size. Now, to kind of, you can see I have these columns here in my options chain, BS and AS, that is bid size and ask size. I always have this up on my options chain. I'm kind of curious as to where the weight is with the spread, okay? And so I'll explain that in just a moment. But if you're unfamiliar with with bid size and ask size. Bid size basically represents the minimum number of options contracts that a trader is willing to purchase at a specified bid price. So with this, we see BS bid size on these at the money SPY contracts. We see a bid size of 29 for the 133 bid, and we see an ask size of 390 for the 136 ask. Now, what does this tell me? This tells me that these particular contracts are more heavily weighted on the ask side. Now, with stocks, you can use the bid ask to kind of get a feel for if a stock is bullish or bearish, or on a very short-term scale. I don't personally use the bid ask or the sizing in that manner on options contracts. I'm purely looking for where the audience is on these contracts, and how I personally use that comes down to whether or not I'm going to be placing a market order or a limit order. Now, something like this, if I wanted to come into SPY here and buy 50 contracts at the ask using a market order, you want to make sure with your market orders that you're going to get filled at the price that is advertised. So you want to make sure you're going to get filled at the 136 price that we see here on the ask. Now, if you come in with 50 contracts and you want to buy at 136, the ask size is pretty much confirming to you that you can go ahead and get filled with 50 contracts at 136. This is not always the case, and this is very important to recognize when you're using market orders as opposed to limit orders. Let's try and find something here. Maybe if we go back to beyond. So looking at this, if you come in with 10 contracts, you want to buy 10 contracts at the 1230 price, they're not all going to fill at 1230. The max you could get at 1230 is going to be 6. So keep this in mind if you're trading with market orders. You want to always be looking at the ask size, especially if you're trading with a decent amount of size. Now, if you're just slinging around 1 or 2 contracts as you learn, this is not really a big deal, not really a big consideration. But as you start to scale your account and trade with more funds, this is going to be very important for market orders. Regarding limit orders, the bid size and the ask size can kind of give you a feel for where you're going to get filled on your contract. So let's take a look at Apple again. We can see that these weekly at the money contracts right here, the 195 call, is more heavily weighted on the ask again, with the ask being 151 available at 145 and the bid size being 20 available at 140. Now, what is this telling me if I'm using a limit order? Well, generally speaking, you kind of want to get filled. Well, I mean, obviously it's better to get lowest price possible, but when you come in with a limit order, you're generally going to be entering it at the mid price. So let's say 142, 143. Looking at the bid size and the ask size, I can see that the ask size is more heavily weighted. So instead of going for 142 with my limit order, I'm going to see how heavily this is weighted, and I'm probably going to move it up to 143, maybe even 144, just because I know there's a greater number of contracts available at the 145. Now, this is, again, assuming I don't want to just go ahead and use a market order. So something to look at when you guys are placing orders, bid size and ask size. It's not the most important concept in the world when it comes to options trading, but it is something that is going to help you, especially if you are, swinging around market orders with any kind of size behind them. You're going to want to look at this ask size and bid size.